You're listening to Economics Detective Radio. Returning to the podcast today is Sam Hammond of the Niskanen Center. Sam, welcome back to Economics Detective Radio.
Thanks for having me.
So today we're going to talk about the welfare state. In particular, we're going to talk about this idea of the free market welfare state. I think a lot of people kind of think of those two things as opposites, but as we'll discuss, they're not necessarily opposites, and in some ways they can be complementary, or at least some people argue that they can be. So Sam, both you and Will Wilkinson have been writing articles about this recently. What sort of prompted this discussion?
I guess to start with, me and Will both come from a sort of conventional libertarian background, and kind of in our intellectual evolution sort of started to see the merit in the welfare state as complementary to free economic freedom and personal freedom. And so that involves quite a bit of, soul searching on our own part and questioning a lot of our previous assumptions. I think the starting point for me was recognizing that the, conventional big government, small government axis is based more on like a mood. There's like a mood that says, I don't like the government. And there's a mood that says, I like the government. Depending on your temperament, you're either a progressive or libertarian or somewhere in between. But moods are not like, they don't actually reflect how things actually work. And when you look at the empirics and, cross-national surveys and stuff like that, you end up finding this sort of inconvenient fact, which is governments that have robust social insurance programs, like large welfare states, like the Nordic countries are at the top of mind, routinely rank and outrank the United States for one in measures of economic freedom and in measures of innovation and measures of, conventional measures of how free the market is. And the even bigger irony there is a lot of the times those rankings are constructed by conventional libertarian organizations like the Cato Institute or the Fraser Institute, who have sort of, if anything, they're motivated to bias their results against large welfare states. But routinely, Denmark and Norway and Sweden, but even sort of mixed market economies like Canada and New Zealand rank in the top 10. Well, at least by recollection, the United States has been slipping in those rankings.
Yeah. Those rankings are interesting, and it's worth touching on them. There's one from they do often come from right-leaning or libertarian think tanks. These economic freedom of the world indices. The Heritage Foundation does one that is sort of a black box. So you mentioned that they might have a bias, and for all we know, they do, because they kind of come up with the index, the weightings of the different factors behind closed doors. But Fraser is very transparent, and so it would be very hard for them to put their thumb on the scale, except by drastically changing their ranking. So when researchers,
one way it's not exactly putting the thumb on the scale, but for instance, if your index in the measure of government size includes both public spending and revenues, those things are like highly correlated. Obviously, over the long run, governments balance budgets like over an infinite horizon. So you would expect tax revenues to be roughly the same size as total government spending as a percentage of GDP. So if you include both of those in your ranking, you kind of double count. And so that's one thing that comes up. I'm not exactly sure if that's in the Fraser ranking, but it's a way that sort of biases results that can be totally transparent.
Yeah. Well, and I guess for some intellectual background, people always, we often see that people like Friedrich Hayek, says in one chapter of I think The Road to Serfdom, he sort of says, this whole thing about economic freedom, it's not necessarily contradictory with a welfare state. And Milton Friedman had his famous negative income tax, which is sort of a different version of the basic income proposal, and then Charles Murray is another. He's not an economist, but he's a right-wing thinker who wrote a book called In Our Hands, where he writes in support of a basic income guarantee. And people kind of see this as sort of like strange, like that this person just woke up on the wrong side of the bed one day and said something that was the opposite of what the public thinks they stand for. But it sort of reflects this separability between economic planning and regulation on the one hand and transfer payments on the other. Do you want to talk about that separable nature of those two?
Yeah, sure. I mean, there's a famous expression that's sometimes attributed to Paul Krugman, but I think someone else said before him that the picture you should have of the federal government is a large an army with an insurance program. And that is like an actually pretty apt description of modern welfare states. Like most of what the federal government does, particularly in Canada, but including the U.S. and even the Nordic countries, is just move money around. Especially so in Canada, because the federal government it tries not to interfere with what the provinces are doing, so it just gives them large grants, block grants. Like conceptually, well, at least philosophically, it made sense to me with some libertarian background to differentiate between a regulation that says, like, thou shalt not do X, thou shalt not develop a piece of land or build a property above a certain height restriction or something like that. That's a regulation versus a transfer, which is something like, I can build buildings as tall as I want. I'm going to be taxed, and some of that will be transferred to people who are on hard times. Those, like, one tangibly interferes with my planning decisions, which is sort of a Hayekian point. Like, it tangibly interferes with me unveiling my planning and investment decisions, and the other just moves money around. Of course, if you take a hardline libertarian view that all taxation is theft, then that might be too fine of a distinction. But maybe part of where Will and I come from is having a different vision of freedom that is not just the absence of taxation, but the ability to chart your own life course.
Yeah. So one interesting point that both of you make is that we shouldn't be thinking of government transfers as public charity, but as public insurance. So what is that distinction? What's the difference? Both insurance and charity take from people who have more and give to people who have less, on some dimension. So, insurance, if you have health insurance, it takes from the healthy and gives to the sick on net. And if you have employment insurance, it takes from people who have jobs and gives to people who are between jobs. And charity takes from people who are charitable to people who are the recipients of charity. Maybe they're sick, maybe they're poor. So what's that difference? And why should we think of the welfare state more in one way and not the other?
Well, I mean, if you look at private insurance, if you have fire insurance and your house burns down, that's money coming from people whose house didn't burn down. But yet we buy insurance and we actually profit, like, individually benefit from insurance ex ante, because we don't know the actual risks of whether our house is going to burn down. And so there's actually a tangible gain to having, like, a level of economic security, financial security, just certainty about future states of the world, right? And that's why insurance can be Pareto improving in the private realm. The point of thinking about social insurance in the public realm in a similar way is, if there are transaction costs or principal agent problems or other forms of market failure that prevent an ideal provision of insurance to the private market, then it's possible to interpret what the government does when it provides social insurance benefits as sort of standing in for that market failure. And the reason I like to emphasize this, like, it's not that there's no redistribution going on. Obviously disability programs, if you're born with a disability, that that there's no uncertainty about the future. You're going to have a hard time earning as much as someone who's born without a disability, and so that's more of a pure redistribution. But it's useful to start thinking of things more in this light, in part because it disrupts the normal libertarian or conservative way of seeing this as just taking from makers and giving to takers. And it also, the funny thing about that view is it actually shares a lot with egalitarians. Like, hardcore income egalitarians want to, totally level playing field. This is a third way of seeing things. It's not zero sum. It's possible to have transfer schemes that actually increase the total pie.
Right. So with any insurance scheme, though, you have adverse selection and moral hazard. Do you want to define those talk about how both private and public insurance face those problems in one way or another?
Yeah, for sure. Moral hazard is just when you have a risk that you're insured against, you're more likely to be careless. If you have fire insurance, you're not as vigilant about turning the stove off. And this sort of gets translated into public debate as an issue of personal responsibility. So, I think it can actually be kind of enlightening to whenever you hear a conservative critic of the welfare state discuss it in terms of, this is undermining personal responsibility. Really what they're talking about is it's creating moral hazard effects. It's better to try to pull it out of that more moralizing language about personal responsibility and think of it more in terms of like an engineering problem or an economic problem, which is, just like in private insurance, there's a risk of there being too much moral hazard or relative to the economic benefit or too little. So, and moral hazard effects and adverse selection effects, some of the key reasons why the private market ultimately does fail to provide different types of insurance that the government ends up providing. So a good example is related to the literature in the poverty world around is sort of under the heading of the feminization of poverty. Particularly in the United States, the poorest households tend to be female-headed and tend to have children. The reason for this goes to the issue of the conservatives like to talk about a lot as well, which is divorce and family structure. So there's one way in which you can see like the old school welfare program in the United States as being a kind of divorce insurance. Like if you were a mother, stay-at-home mother, living with the father, and then divorce happened, or maybe he died, you were fully burdened with taking care of the child, and probably didn't have too many skills because back in the day women weren't expected to work. And so the original welfare program, AFDC in the United States emerged as in the Great Depression and after the war, because a lot of mothers were at home and their husbands didn't come home from the war. It emerged under the title of mothers' pensions, but you could sort of see it as a kind of widowers or divorcees insurance. Now, conservatives raise the obvious objection. Well, if you insure people against divorce, you're going to create more divorce, and that is an issue. And I think that's actually the margin for debate is in any one of these social insurance programs, like unemployment insurance. If you have too generous unemployment, you will not encourage people to get back in the labor force. This is about on the margin, where do costs exceed benefit, as opposed to an in principle objection to the welfare state.
Yeah, I want to clarify that point about if you're too generous with your unemployment insurance, you're encouraging people not to rejoin the labor force. That's true, but in particular, it's the phase out that disincentivizes work. So it's the fact that you take away the employment insurance when someone gets a job or when they reach a certain income threshold. And the current system in the United States has a lot of what are called welfare cliffs, points where if you're eligible for several different programs that all cut off at, say, an official poverty line, the $1 that pushes you over that line could lose you $10,000 in benefits, which is, much higher than 100% marginal tax rate. It's, can't do it in my head. 100,000%, something like that.
Right. In the U.S. case, some of this has been overblown. Like one big reason why welfare reform in the 90s was probably necessary was the existing program had like 100% phase out rate. So you earn a dollar, you lose a dollar, and that's like one of my big themes is that the details matter a lot for how you interpret welfare programs, and that is a important detail to note. Nowadays, this is a bigger problem with in-kind benefits. So in the United States, Medicaid is a sort of insurer of last resort for low-income people. It's not like there's a phase-out range where you get 50% Medicaid. You either have Medicaid or you don't. And so there are income cutoffs where people just, they're incentivized not to try to get a high-paying job because they'll lose their health insurance. And this is part of the case for having more universal coverage. Counterintuitively, you can eliminate some of these effects by just moving the benefit up the income scale. In the case of healthcare, like no one in Canada really decides not to work because they want to maintain access to health insurance. There are many problems with the Canadian system, but that's not one of them.
Yeah, so the welfare reform you mentioned in the 90s, I think that's when they brought in the earned income tax credit. Is that correct?
Well, yeah, that was created a lot earlier, but it was greatly expanded in 1997.
Right, and that's one that's a program that actually phases in initially. You actually earn more from EITC when you work a little, and then it phases out gradually as your income increases, but not fast enough to ever make you turn down a raise, or although it might incentivize you a little to work less hard. One other distinction to make in all these discussions of moral hazard in the welfare state is the intensive margin versus the extensive margin.
Right.
When we're talking about workers, the intensive margin is maybe your welfare will disincentivize you from working, and so you'll work less hard, but you'll still have a job. So maybe you don't push for that promotion. You don't work hard enough to get a raise because you know it's going to be canceled out by losing some benefits. That's not so much of a concern because you are still working. But what economists really worry about is the extensive margin, where you might choose not to work at all because you might lose benefits. So I think disability in the United States is particularly bad for this, because if you're collecting disability, you can't do anything that is even remotely similar to work. If they find out that, say you were a welder and you got injured and you couldn't weld anymore, if you started doing something on the side, like have a podcast like this one and maybe earn a few dollars off it, you would make yourself ineligible for disability.
Yeah. So in the past, as a Nova Scotian, I've described that as a lobster trap. It's something you can easily get into, but it's much more difficult to get out. But that's a bit of a misnomer, because disability in the United States is actually quite difficult to get on. But once you're on it, it doesn't really pay to leave it. In fact, you might even be investigated for fraud if you weren't truly disabled. So and if I'm sure you've covered this in your podcast before, but David Autor's big splash paper about the China shock. This was in the early 2000s when China entered sort of normal permanent trading relations with the WTO. There was a massive import shock to manufacturing regions across the United States. That sort of correlates with the Rust Belt. It correlates quite a bit with the Trump vote. Autor's paper is really interesting is looking at what social benefits were responsive to that shock. So the United States has a program called Trade Adjustment Assistance, and it's dismally funded, very central planning like, because they try to take anyone disrupted by trade and figure out somehow what the next job will be and train them for those jobs. And so that went up a little bit in response to the China shock, but went up dramatically and went up more than anything was Social Security disability insurance. Someone might look at that and say, well, we need to really tighten Social Security disability. But I look at it and say, actually, guys, we need an alternative program so that Social Security is not because we need a disability insurance program. We also need a alternative for people who are still able-bodied and to have a path of least resistance, to be springboarded back into new jobs. Economics, we kind of talk about active labor market policy. That's any kind of policy that actively spurs labor market participation. It could be job training, but it could also be wage subsidies. Since the 80s, as a percent of GDP, spending on active labor market policy in the United States has declined from 0.24% to just under 0.12%. So it's more than halved. Part of the big context of the China shock in the United States is this background of a slowly decaying infrastructure of active labor market policy, and that would actually help those people rebound into new jobs. And economists have always said the gains from free trade outweigh. There's more winners than losers, essentially. But in principle, the economics textbooks tell you're supposed to compensate the losers, right? And we've been failing to do that. And part of my argument is there's this general phenomena of economic insecurity, created by innovation, created by trade, created by just a competitive market economy. And that economic insecurity builds sort of like pressure. And there are different ways that pressure can, be released. One pressure valve is through populist uproar, through protectionism, through re-regulation of industry, through closing borders. Another pressure valve is through social insurance policy. And I think this in part explains why the Nordic countries are the way they are. They are countries that are deeply embedded in global trade. They're majority exporting countries. And for that reason, if, preferences around the world shift, they might have to totally restructure their industries. And so they can't afford to not be flexible and not to have serious labor market flexibility and active labor market policy. the US, because it's so big and such a big internal market, has been able to sort of sit on its laurels because exports are such a small percent of GDP. But what we've seen in the 2000s is that even the United States is not immune to trade winds. And if predictions come true that we're on the verge of a big productivity boom with new technology, artificial intelligence, so on and so forth, then the United States is really underprepared for the technology shock that will hit our markets.
Yeah, the interesting thing with that David Otter paper is the China shock, which for all intents and purposes, it seems like it's a one-off, that there could be such a large trade shock all at once, hitting the global market, as happened when China joined the WTO. There's no other countries out there the size of China. There's and maybe you could have rapid economic growth in Africa and a lot of trade there, but it does seem like it's kind of a once in a lifetime event. But some of the interesting things to come out of that research is just how localized the shock was. So you had small towns in the Rust Belt of the United States that had exactly one factory, the one factory town. And
right.
If that factory was a furniture factory, then it's probably gone now. The American furniture industry was completely supplanted by cheap Chinese imports. And if you're a skilled furniture factory worker and you've been working there for 15 years and you were expecting to work there for another 25 years, then it's a lot of people, rather than, they couldn't just get another job where they lived because that was the industry where they lived. Everything else was in support of that. And so they could have uprooted and gone to San Francisco and retrained to be a computer programmer or something. But most people did not do that, and something that happens in a lot of these towns, or I've heard more anecdotally, is you have doctors who will, you go in and say, my back hurts, and, shop around to 3 or 4 doctors, and they'll get you onto disability, which will provide income until you're eligible for Social Security. So a lot of these people permanently exited the labor force. A lot of economists, I think, beforehand would have predicted that, you destroy one industry and the workers in it become available labor for some other industry. But part of it was the spatial nature of it, where the gains came in San Francisco and the losses were in rural Kentucky. And it's hard to physically move people from one place to the other, especially given the housing costs in coastal California and other hot labor markets.
Yeah, exactly. And this is just some of the realities of the labor market in the real world. It's full of frictions. What is the willingness to pay or willingness to accept for someone to leave their hometown? It could be a lot of money, because even though you or I may have moved around in our life, for a lot of workers, they don't know anything but their hometown, and they're not just cogs or they're not just like some commodity that can be shipped across borders, which is a big motivating factor why I think active labor market policy is an important role for government intervention to sort of grease the wheel of labor markets, in part because I'm very concerned about a lack of responsiveness or lack of automatic stabilizers generating a populist backlash. Like moral hazard, we just discussed, can kind of work both ways, right? Like there's a moral hazard of not working, but when you have a safety net, you also have a sort of positive moral hazard, which is that you're more likely to take job risks, you're more likely to switch jobs, you're more likely to move between state lines if the insurance is provided in a way that's portable. These are like important pieces of the puzzle to a well-functioning market economy, given the fact that we aren't commodities moving around.
Yeah. So you mentioned moral hazard. I just remembered that when I asked about moral hazard, I also mentioned adverse selection, which we didn't talk about. So give the definition, which is when you have an insurance program. So moral hazard, as we said, if you're insured against fire, you won't be so careful about making sure your oven's not running. Something like that. You might light more candles on your birthday. So
Right.
little things. But those are all like after you get insurance. Adverse selection is a little different. It says that the people who will self-select into an insurance program are the highest risk people. So
Right.
there you had this issue with Obamacare, where American health insurance prior to Obamacare is tied to employers. It's actually a very strange system. And so if you got sick, you couldn't then switch jobs, because then you wouldn't be able to get insurance because you're already sick. And if an insurance company were to let anyone get insurance, regardless of whether they had a pre-existing condition, no one would ever get insurance until they got sick, right? And the insurance company would only have sick people, and then they'd have to pay out more money than they take in, and it would not be a viable business model. Obamacare, it was really unpopular that a sick person without insurance couldn't get insurance. And so they came in with these. So in order to make it so someone who was sick could get insurance, they had to make it so healthy people are forced to get insurance. Otherwise, the whole system would break. And that's just, one example of dealing with the adverse selection problem. So
yeah, I can sort of elaborate on that. There's a few things to hit on there. The adverse selection problem also, there's a parallel case with credit markets and borrowing. Like the reason why payday loans or loan sharks in poor neighborhoods charge such high rates is, again, because of adverse selection. Because if they charged a kind of like a rate that, there are probably plenty of people in the community that are good for the money, that will get the payday loan and pay it right back. But there's enough. But if they set interest rates for them, it will attract too many of the bad apples who are just going to default on any borrowing they do. So you end up having to charge a very high interest rate. And I think there's an analogy between, the market failure approach to looking at social insurance and the market failures that take place in credit markets. One of the studies that I looked at found Medicaid expansion in California led to a 10 percentage point decline in payday loans being made. People were taking out payday loans to pay for their health insurance, which is sort of astounding. But it also shows that there is serious market failure taking place at sort of multiple levels. And often the problem with Obamacare was it tried to sort of have its cake and eat it too by keeping existing employer-based insurance alive and sort of grafting on this individual marketplace. Jane Jacobs would call that a monstrous moral hybrid. You're trying to have sort of two systems that have incompatible axioms try to work together. Whereas if you just had a simple public option was associated with the left in the Democratic Party, I think you'd actually end up having better functioning markets. You'd have people would be able to switch jobs more easily because they wouldn't worry about losing their spouse and children's health insurance in the process. People would be able to take risks and start new businesses because they wouldn't worry as someone who's self-employed that they'd be uninsured. These are things that sort of are obvious to a lot of economists, but it's incredible. You go up and you talk to lawmakers, and they have a difficulty seeing it this way. They see employer-based insurance as sort of like something you work to earn, neglecting the fact that the U.S. government subsidizes employer-based health insurance by $250 billion every year. It's the largest tax expenditure, a massive subsidy for employers to continue being the main insurance provider, and it's a screwed up system. If you could take insurance out of the if you could take insurance away from being a responsibility of the employer to being the responsibility of a higher level or higher unit of organization, state government or federal government, then all those sort of lower units get to move around and change and be flexible and dynamic.
Yeah, and it's to build on this adverse selection sort of story. The great thing about a public social insurance versus a private one, with something like employment insurance, you can imagine a private employment insurance scheme, but the people who bought into it might be the ones who were most likely to lose their jobs, people with the least secure employment. And just having it be public, it just eliminates that problem. Everyone buys in automatically. Although it does have additional costs, for instance, just in general, public bureaucrats or public bureaucracies are just generally less cost effective than private ones, just because they have those soft budget constraints.
Sometimes, I mean, large insurers, private insurers have advertising budgets, marketing budgets that probably, as a percent of their total operating cost, outstrip what the Social Security Administration has, which is, Social Security Administration has some bureaucratic bloat, but it's a tiny fraction of the total amount of money that they move around. The other way that public provision helps the adverse selection problem is just the fact that it reduces competition. And to a libertarian's ear, that might just be like, what? I thought competition was always good, but adverse selection is the result of competition. It's when you have, you could have a pooling equilibrium. That's when you sort of have one price for everybody that is relatively stable until you have a competitor come in and reprice the insurance product to capture some of those lower risk people. Like maybe they offer a discount premiums for super low risk people. And it's that process of competition that actually drives adverse selection. So counterintuitively, insurance doesn't obey our normal intuitions as economists about how competition is always and everywhere virtuous.
So one thing you've talked about is the difference between in-kind versus cash transfers. This is something Milton Friedman used to talk about a lot, where there's sort of a paternalistic motivation for giving in-kind transfers. If you give someone food, then it's not fungible, and so they can't spend it on drugs. People are very afraid that poor people will accept welfare payments and then buy things that they don't approve of, like illicit substances. But a lot of economists prefer cash transfers to in-kind transfers. So talk a little bit about that. Why? What are the advantages and disadvantages there?
Well, part of my motivation for writing a lot about the case for cash is trying to reframe the way libertarians and classical liberals can contribute to the welfare reform discussion that isn't just about aligning of conservatives and about cutting entitlements and so on and so forth. And one of the positive ways we can contribute is by sort of applying ideas around rule of law and local knowledge, individual autonomy, and importing those to the structure of social insurance programs. And just picking one of those, like rule of law. One of the things that falls out of rule of law is the government is supposed to be relatively neutral to different ways of life. The government doesn't, we can't have an established church. It's supposed to protect freedom of speech. It's supposed to not endorse explicitly different controversial values. It'd be weird if the welfare state gave you more money if you were a Catholic than if you were a Protestant, right? What if we just reframe those sort of religious beliefs into different value sets? It's equally problematic for the welfare state to reward you for doing certain prescribed behaviors above and beyond sort of what you need for just maintenance of the program. So if the goal of active labor market policy is to get people back to work after a big labor market disruption, then attaching it to work makes sense. It doesn't always make sense, and it doesn't make sense to be drug testing people who have paid into unemployment insurance and just want to get their benefit that they paid into. Number one, it presumes that there is something wrong with consuming drugs, which that's up to every individual person. And part of the problem is when you start allowing these things on the margin, and this includes the issue of in-kind benefits, you sort of open up Pandora's box. And I'm not a big fan of slippery slope arguments, but it's sort of a slope that we've already run down. Like in the United States, SNAP, or more commonly known as food stamps, has all these rules around the kind of grocery stores that are eligible. But last year, I think around last year, maybe a year and a half ago by now, they updated the rules. So the grocer was required to have, goat's milk, and it had to check a certain number of boxes. And some of the criteria were do you have goat's milk? Do you have fresh vegetables? Do you have lamb chops was one of them. And the idea here was that some bureaucrat thought, well, if we restrict food stamps to places that have lamb chops and goat's milk, then people are going to eat healthier. What's it their business how that person is eating? What's it their business to impose these in a kind of stealth draconian way? Like that ends up, in a sense, sort of regulating the poor people's lives, and you end up with this like two-tier economy where to be poor is to have your choices made for you. From the perspective of sort of individual dignity, that is offensive on its face, even if it's a way that I can contribute to the conversation that isn't just about the binary question of whether we should have food stamps or not.
Yeah, and I think that's in the public debate versus the debate economists are having. The public debate, there's a lot of for or against welfare just in general, all of it, all the existing programs, all the potential programs. In the economics debate, there's a lot of fine discussions about distinctions between one program and another and the kind of incentives they generate. I'd like to see more discussions about more philosophical ideas like personal autonomy but yeah, that example with SNAP just kind of shows how certain kinds of programs, in addition to giving you something, and taking away from someone else to pay for it, also give the administrators and the politicians the power to control what you're doing and control aspects of your life. So, now you must shop at a grocery store with goat's milk because someone thought it was a good idea. But with something like a basic income, it's just a automatic transfer into your bank account every month, or you file your taxes and your income's below a certain amount, and so you get the negative income tax. Something like that is much less likely to influence your actions or to force you into a certain lifestyle that someone else approved of.
Right, and first of all, there are some just straight up myths about how poor people spend their money, that they spend it on tobacco or alcohol or drugs. Statistics just do not bear that out. In fact, when you increase people's benefits, they tend to spend a smaller proportion on tobacco and alcohol, partly because tobacco and alcohol are stress reducers, and if you really relieve people's stress, they're less stressed in their personal lives. So that's one thing. But the other thing is even if it was the case, it's the same people who are pushing for the same people who are arguing for cutting the programs on the basis of personal responsibility are also the ones that tend to be advocating for more strings to be attached to different programs, which is a contradiction. Like, if you really value personal responsibility, then we're going to give you a benefit. It's going to be cash based, and it's up to you to spend it wisely. And we're not going to presume what quote unquote wise even means. This debate came up in Canada most prominently in the mid 2000s, when I think it was the Liberal Party, maybe it was under Paul Martin. I can't quite remember, but they proposed a national daycare program. And it was a big deal. Like, Quebec had already for 9 or 10 years had a provincial daycare program, universal daycare. The Liberal Party was going to expand it to the nation. The Conservative Party interjected and said, wait. You're trying to impose your values here. We, as conservatives, we represent traditional families, a lot of immigrant families that use family members as their main form of childcare. You have a particular ideology which says we want all those people to be pushed into the labor market, and that violates sort of a concept of neutrality or rule of law. And so the Conservative Party came out with the universal childcare benefit, which was just a flat payment to families per child, sort of like a universal basic income for kids. And the argument then, and remains to be the case, it was, this is a way of being neutral with respect to how you want to live your life. If you want to live your life, if you want to use the cash on professional childcare services, or if you want to sort of see it as compensation for home production. And a lot of countries are looking to Canada, and Trudeau expanded the childcare, the Canada Child Benefit dramatically, and people are looking at it as an example of how to sort of address issues of child poverty, but do it in a way that's both efficient and non-discriminatory.
Yeah. The interesting thing with that, I'll just say it's true. It was Paul Martin's Liberal government that tried to introduce universal childcare. And the interesting thing is that it was a coalition of the left and right, the Conservatives and the NDP, who are Canada's left-wing party, brought down the Liberal centrist party partly over this universal childcare issue. So it's sort of another case where if we just thought of things as a more versus less spectrum versus a government control versus personal autonomy spectrum, we would miss a lot of the broader picture here of not just of all the possibilities that are out there for public policy, but also of the way electoral politics works and has historically worked in the past.
And this is just sort of icing on the cake of the fact that study after study finds cash to be sort of the high watermark for policy intervention. In the same way that, like in a healthcare intervention, you want to compare. You don't want to just compare the medicine against a placebo. You also want to compare it against like the next best medicine. Often, like when we do these studies of poverty interventions, the sort of in-kind benefit, the different scheme for doing integrated case management and stuff like that. When you compare it to just giving people cash, it ends up being either no difference or cash wins, sort of time after time. Part of this goes to that old libertarian insight that people have local knowledge of their place and circumstance, and they have the greatest ability to allocate that money in ways that are maximally beneficial to them or their children. There are cases where people make poor decisions, but even in cases of extreme poverty and dysfunction, it's hard to do better. Even where people are making mistakes routinely, it's hard for a bureaucrat to do better.
Yeah. So I want to touch on the controversial part of, well, I guess this is all controversial, but a lot of people like having a welfare state. Most people, left and right, like some form of it. Most people are not totally opposed to it, although some people are. But one thing you hear over and over again is, yeah, we can have a welfare state, but we got to put a fence around it. You can't just have a welfare state and then let every single impoverished person in sub-Saharan Africa or Latin America move here, move to this rich country, whether it's Canada or United States or somewhere else, and then go on welfare. The intuition behind this is sound. It's once again this adverse selection problem that you have a system that pays to people who are poor, and if people can self-select into that system, it's the people who are most likely to be poor who will self-select in, because everyone else pays. People who are not poor presumably pay in taxes. So how do you make the welfare state a welfare state that is robust to migration concerns?
Yeah. So this is use the word robust. It's the concept of a migration robust welfare state. This is something that sort of keeps me up at night the most. As much as I'm a fan of sort of simple, cash-based programs like negative income tax, there is a dark side to them, which is if you make a benefit that is totally unconditional, just an unconditional cash transfer, for example, you do have this issue of how do we trade off that with our other priority, which may, like, at least for me, is having a relatively open and free immigration system. You can sort of think of it in analogous to the way, I was talking about welfare state as an insurance provider. States are basically like big insurance co-ops or cooperatives, mutual co-ops. But when you look at mutual co-ops in the real world, they tend to have kind of closed borders. They tend to be kind of restricted. There are ways around this problem. One way is to shift the most generous unconditional benefits, the ones that have the most sort of salience if a immigrant were to come in and start using that benefit, into a contributory model. So for example, social security, people pay into it throughout their life. It's a bit of a hand wavy thing because it's not like the money's going anywhere. You're sort of paying money into a trust fund, but then the benefits get paid out of general revenues. But nonetheless, the fact that you're paying into Social Security through your payroll tax does create a psychological link between your earnings and your retirement. And I think that link is important for Social Security because it is a otherwise unconditional flat income payment you get after you retire. And so the more a program looks like that, the more I want it to have a contributory element to it, even if it's not fully self-financing. So, one of my worries is child allowance. Like, Canada has a very robust child allowance, but Canada also has very high skilled immigration. If America were to do something like that, it would definitely need to build protections around it not because that's ideal policy, but because if you care about the policy having any sustainability, you don't want it to be abused, and you want to sort of anticipate public reaction. One idea, which I think is really interesting, is people only have a few kids in their lifetime, if at all. Why not fund a child allowance, let's say, deferring a month of your retirement or something like that? So you could essentially link the benefit of a child payment to the Social Security system and say, I have a child, I need financial assistance raising my child, and to be eligible for this, I will have to retire a little bit later than I otherwise would. And that instantly builds in a psychological and conceptual connection between contribution and receipt that I think might not be the answer, but is one possibility. But I definitely think it's a really underexplored topic, and part of the reason it's underexplored is because we get stuck in these debates about whether rather than how.
Yeah, that is interesting. So if you need income support after having a child, say you're out of the labor force for a year, then you can get it from the government, but instead of retiring at 65 and collecting Social Security or in Canada, it's the Canada Pension Plan, CPP, you become eligible for it at 66. Is it that's basically what you're proposing?
It could be like that, or it could be that your fixed income is a bit lower. You could make it equivalent.
Okay, so yeah, but almost like taking a loan against your future expected payouts, but just built into the system so that there aren't issues of creditworthiness and things like that.
Exactly. Yeah, and that's the perfect analogy. Like when I ask myself, what is the market failure in childcare or in having a child? Because you do see these enormous efficiency gains from cash transfers to families. The way I sort of think about it is, well, we're missing a financial market here, because if it was easy, like some of the early childhood investment studies find like a 10% rate of return investments in early childhood development. If a 10% rate of return is almost twice what the market rate of return is. So, why is this money on the table, so to speak? Part of the reason is that you can't capture the benefits of that investment if you're the one making the investment. So we have this thing called human rights, which are great, and I don't want to get rid of them. But what it means is that you don't actually own your child, and if you put in a bunch of investment to your child, or you get a loan or raise equity in your child, you're not actually entitled to the fact that they're going to have higher earnings down the road. And so that creates a kind of incompleteness in financial markets. A direct cash transfer, sort of horizontal transfer from one generation to another, it sort of substitutes for. It's sort of a second best policy.
Yeah, and that's one of the issues that economists worry about when they're studying poverty is credit constraints. Just the idea that in a lot of our economic models, we kind of assume that people can both borrow and lend or save the market rate of interest, but that's not really true for you, especially if you're poor. You may not have any access to loans. You may only have access to very high interest loans because of your likeliness of default. And sometimes, going back to the cash transfers, we look at things like the charity called Give Directly that does these cash transfer experiments, and they'll give to people, and people will replace their thatch roof with an aluminum roof, which thatch roofs are very costly. They have to be replaced very often. Aluminum roofs have a much higher one-time upfront cost, but the return on investment from buying this thing that doesn't have to be replaced for a decade after you buy it is shockingly high. Shocking because you'd think that something that was offering such a high percentage investment, I forget the exact number, but much higher than you could get investing in the stock market or anything like that. You'd think that would be captured in the market, but people just can't get access to the liquid funds. And so it's interesting, the idea of making a welfare system that also has market rate loans sort of built in, the ability for people to get cash when they need it, but not just as a gift, but as effectively a loan. When you mentioned contributory in context of a migration robust welfare state, I had in mind something more like an entry fee when you migrate to sort of buy into the system. Would that be part of a contributory model or one version of it?
It's definitely one version of it. The old phrase from Bill Niskanen, build a wall around the welfare state, not around the country, that has a lot of intrinsic merit as well. Like an economic migrant to the United States, for instance, will see enormous welfare improvements, like individual welfare improvements, just from moving. That gives us a lot of reason to be happy, even if we restrict their access to a full suite of public programs. Like in the U.S., for instance, you're not able to access any major public assistance programs until you're a legal permanent resident for at least 5 years. Paying a large entry fee is another option. I sort of wonder if it would work, because chances are, if you're the kind of person that's going to require public benefit, you're not going to have a lot of disposable income sitting around to pay the membership fee.
Yeah. Well, this is all. I suspect we could talk about the welfare state and different potential versions of it. We could sit around and talk about that for hours and hours. Let's just do some concluding thoughts. So, the welfare state, as it currently exists, would you say, how close would you say that it is to an ideal or efficient welfare state?
I would say the ideal is probably somewhere between Canada and Denmark. So there's probably a happy medium there somewhere. The United States, one of the issues is it has a very, what I've called a reluctant welfare state. It's been created in kind of fits and starts, the Great Society. And, these reforms come in the New Deal. Like, these reforms come like every 30, 40 years. And they're often very partisan when they go through. And often, because there's this resistance to redistributive policy on the right, Democrats will often be, willing participants in attaching work requirements, attaching these sort of strings to buy support for their policies. So I think the U.S. has a long way to go. Just on child benefits, it's about $200 billion per year short on what the OECD average is for cash benefits to kids. And that's partly why it has the highest child poverty rate in the OECD after Mexico and Turkey. But if we're talking about ideal states, like, we point at Denmark and Sweden as examples, as sort of proofs of by example that you can have an incredibly free market, some of the most flexible labor markets in the world, and have a large welfare state. And in fact, the welfare state enables that flexibility. But that does not mean that the United States or Canada or anywhere else can just copy those countries. But it does point to ways of thinking about the issue. I think it's an issue that we're going to have to think about a lot more. You mentioned that the China shock was a one-off incident, but there will be more shocks on the horizon, whether it's a trade shock or technology shock. Otherwise, that's pretty sad. It's more pessimistic to think otherwise, because you're otherwise saying that innovation has stopped.
Right. And I might mention one shock that's definitely coming. The most common job in the United States and probably in other similar countries like Canada is driving, truck drivers, right, and taxi drivers, and there are many, many driving jobs. And pretty soon, next 5 years, maybe we're going to see a lot of those jobs being replaced by autonomous vehicles. And,
sure.
And so that there's your next big shock, and how the economy, how we respond to it is going to be a big deal, whether those people get other jobs, find ways to be productive elsewhere in the economy, or if they just lose their jobs and don't get other ones. That's gonna create a big difference in their overall society and standard of living.
Right. And so if you're a libertarian or a free market economist and you're thinking about this, think about what your alternatives are, right? We think about opportunity cost, and our alternatives are not laissez-faire and not laissez-faire. Our alternatives are that these shocks ripple through the economy and people have a cushion to land on and retrain and move to where the new jobs are, or they channel those exact same frustrations and insecurities into regulations that prohibit innovation from ever getting off the ground.
My guest today has been Sam Hammond. Sam, thanks for coming back to Economics Detective Radio.
Thanks for having me.
All right, so this is a pretty controversial topic. A lot of people have a lot of different feelings about the welfare state. I hope we properly addressed your main concerns, whatever they might be. This isn't a general advocation of welfare states or a general condemnation, but the way I see it, it's sort of both. It's arguing that there exists a welfare state that creates social benefit, or a possible welfare state, but a lot of the current programs, a lot of the way things are currently administered, a lot of the current rules don't work. They create a lot of bad unintended consequences. So the discussion question for today is think of a welfare or transfer program in cash or in kind that you like, one that you think works well and is close to ideal, and try to think of one that you don't like, that is the most inefficient or badly run or has the worst incentives. Can be from any country, can be from any jurisdiction. What are some examples of good and bad transfer programs? And if you want to join in the discussion, if you want to answer that question, you're going to need to join the Facebook group. That's Economics Detective on Facebook. It's a private group, so you can request entry, and then you can answer the discussion question on the relevant post. I'll be back next week, and thanks for listening.